For decades, Thailand stood as Southeast Asia's economic paragon, a beacon of industrialization and tourism. Its robust manufacturing base and strategic location drew significant foreign direct investment, FDI, solidifying its reputation as a regional powerhouse. Yet, a profound economic rebalancing is underway. The Philippines, once burdened by the sick man of Asia moniker, has quietly, yet decisively, emerged as a compelling new growth narrative. This analytical examination delves into the structural shifts, policy reforms, and demographic dividends propelling Manila past Bangkok, offering critical insights for economists and investors navigating the evolving ASEAN landscape. Thailand's economic trajectory, once characterized by rapid industrial expansion and export-led growth, has decelerated significantly. Political volatility, an aging demographic, and an over-reliance on specific sectors have constrained its potential. In stark contrast, the Philippines has demonstrated remarkable resilience and consistent growth, defying historical expectations. This divergence signals a critical reevaluation of investment strategies and regional economic forecasts. The transformation is not merely anecdotal. It is evidenced by a confluence of macroeconomic indicators. The Philippines now consistently outperforms Thailand in GDP growth rates, attracts a larger share of strategic foreign capital, and leverages a burgeoning demographic advantage. This analytical deep dive will dissect these factors, providing a comprehensive framework for understanding this pivotal shift. Thailand's economy, once a high-growth marvel, has seen its annual GDP expansion taper to a modest 1 to 3% over the past 5 years. This slowdown reflects deeper structural challenges, including a maturing industrial base and persistent political uncertainties that deter long-term capital commitments. The nation grapples with the symptoms of a middle-income trap, where traditional growth drivers lose efficacy without a transition to higher-value production. Conversely, the Philippines has maintained an impressive 5 to 7% annual GDP growth rate, even amidst global economic headwinds. In 2024, its economy expanded by approximately 5.6%, significantly outpacing Thailand's 1.9%. This sustained performance underscores a fundamental shift in economic momentum and underlying resilience. The Philippines' robust growth is underpinned by several key pillars. Domestic consumption remains exceptionally strong, fueled by a large and youthful population exceeding 115 million. This demographic dividend translates into sustained aggregate demand, providing a stable base for economic expansion. Unlike export-dependent economies, the Philippines benefits from this internal market dynamism. Overseas Filipino workers, OFWs, constitute another critical economic engine. Their remittances, exceeding $36 billion annually, inject substantial foreign currency into the economy. These inflows directly boost household consumption and savings, acting as a counter-cyclical buffer during global downturns. This stable source of foreign exchange also strengthens the peso and supports external stability. The business process outsourcing (BPO) sector continues its phenomenal growth trajectory, expanding at double-digit rates. This industry leverages the Philippines' large pool of English-proficient, skilled labor, attracting global firms seeking cost-effective and high-quality services. The BPO sector's evolution from basic call centers to complex IT-enabled services, including data analytics and software development, signifies a move up the value chain. For investors, this consistent high growth translates into tangible opportunities across various sectors. Consumer goods, retail, real estate, and digital services directly benefit from robust domestic demand. The BPO sector offers attractive returns for private equity and venture capital, given its scalability and export-oriented nature. Understanding these drivers is crucial for strategic capital allocation. Demographics represent perhaps the most profound long-term differentiator between the two nations. Thailand's median age has risen to 40 years, positioning it as one of Asia's most rapidly aging societies. This demographic shift presents significant economic challenges, including a shrinking labor force, increased social welfare expenditures, and a potential decline in innovation and entrepreneurial activity. An aging population also implies reduced domestic consumption growth, as older cohorts typically have different spending patterns. The burden on the working-age population to support retirees increases, potentially impacting productivity and competitiveness. This demographic headwind necessitates proactive policy responses to maintain economic vitality. In stark contrast, the Philippines boasts a median age of just 25 years, with one of the fastest-growing young workforces globally. This demographic structure provides a substantial youth dividend, offering a large and expanding labor supply. This abundance of young talent attracts manufacturers and service providers seeking competitive labor costs and a dynamic workforce. A youthful population also ensures sustained domestic consumption, as young individuals are in their prime earning and spending years. This demographic tailwind supports sectors like education, housing, and consumer durables. Furthermore, the tech savviness of the younger generation drives rapid digital adoption, fostering innovation in e-commerce, fintech, and other digital services. For investors, this demographic profile signals long-term growth potential in a vibrant consumer market. Thailand has faced increasing challenges in attracting fresh FDI, partly due to persistent political uncertainties and a global reevaluation of supply chain vulnerabilities. Investors are increasingly seeking diversification beyond traditional manufacturing hubs, driven by geopolitical considerations and the need for supply chain resilience. This has led to a rerouting of capital flows. The Philippines, conversely, is emerging as a preferred destination for new manufacturing and logistics investments. This trend is particularly pronounced as multinational corporations implement China Plus One strategies, seeking to de-risk their supply chains by diversifying production bases. The Philippines offers a compelling alternative, leveraging its strategic location and improving business environment. In 2024, the Philippines witnessed a significant jump in FDI inflows, exceeding 30%. This surge was concentrated in high-growth and strategic sectors. Investments poured into semiconductors and electronics manufacturing, capitalizing on the country's established expertise in this area. The renewable energy sector, including solar, wind, and liquefied natural gas (LNG) projects, also attracted substantial capital, aligning with global sustainability goals. Logistics and infrastructure development have become major magnets for FDI, driven by the government's ambitious Build Better More program. This initiative prioritizes investments in ports, airports, highways, and digital networks, significantly enhancing the country's connectivity and attractiveness for foreign capital. Improved infrastructure reduces operational costs and enhances supply chain efficiency, making the Philippines a more competitive investment destination. The BPO and IT-enabled services sector continues to draw significant foreign investment, reflecting its sustained growth and potential for higher-value services. This influx of capital underscores investor confidence in the Philippines' long-term economic prospects and its capacity to absorb and leverage foreign expertise. For investors, this shift in FDI patterns signals a re-rating of the Philippines as a primary investment hub in Southeast Asia. For decades, Thailand dominated ASEAN's manufacturing landscape, particularly in automotive, electronics, and food processing. However, rising labor costs and a heavy reliance on specific industries, such as Japan's automotive sector, have limited its diversification and competitiveness. Political instability has further eroded investor confidence, prompting a re-evaluation of manufacturing footprints. The Philippines is strategically capitalizing on the global China Plus One supply chain diversification trend. This involves companies establishing alternative production sites outside China to mitigate risks and enhance resilience. The Philippines offers a compelling value proposition, leveraging its skilled workforce and improving infrastructure. The country is rapidly expanding its role in electronics assembly, already ranking as the world's second-largest producer of semiconductors by volume. This specialization positions it favorably within the global technology supply chain. Furthermore, the Philippines has emerged as a global leader in shipbuilding, ranking among the top 5 globally, demonstrating its capacity for heavy industry. The aerospace parts manufacturing sector is also gaining traction, attracting specialized investments. The burgeoning green energy components industry, including solar panels and wind turbine parts, further diversifies the manufacturing base. This strategic pivot towards higher value and diversified manufacturing sectors enhances the Philippines' long-term economic stability and attractiveness for industrial investors. The Philippines' geopolitical location is increasingly proving to be a significant economic asset. Situated strategically along major shipping lanes in the South China Sea, it offers unparalleled access to key global trade routes. This maritime advantage facilitates efficient logistics and reduces transportation costs for goods, enhancing its appeal as a manufacturing and export hub. Furthermore, the Philippines has actively strengthened its alliances with major global powers, including the United States, Japan, and South Korea. These enhanced security partnerships provide a crucial layer of stability and reassurance for foreign investors. Defensive military cooperation and joint exercises signal a commitment to regional security, mitigating geopolitical risks for multinational corporations operating in the country. While Thailand maintains a strategically important position in mainland Southeast Asia, it does not offer the same maritime trade and security advantages that the Philippines now leverages. The Philippines' proactive foreign policy and strategic alliances contribute directly to a more predictable and secure investment environment, a critical factor for long-term capital commitments. This geopolitical alignment is a tangible asset for economic development. The Philippines' digital economy is experiencing explosive growth, expanding at over 10% annually. This rapid digitalization is driven by a young, tech-savvy population and increasing internet penetration. The country is witnessing a profound transformation in how businesses operate and consumers interact, creating vast opportunities for digital innovation. The e-commerce sector is booming, with platforms like Lazada, Shopee, and TikTok Shop thriving across the archipelago. This surge in online retail reflects changing consumer habits and the increasing accessibility of digital payment solutions. The pandemic significantly accelerated this trend, embedding e-commerce into daily life. Fintech adoption has also exploded, particularly in mobile banking and e-wallet usage. The in-bank population is rapidly embracing digital financial services, driving financial inclusion and creating new market segments. This widespread adoption of digital payments facilitates seamless transactions and supports the growth of the broader digital economy. The BPO sector is evolving beyond traditional call centers, moving into higher-value IT services, artificial intelligence, AI, development, and data analytics. This shift signifies a maturation of the industry, attracting more sophisticated investments and creating higher-skilled jobs. The Philippines is positioning itself as a hub for digital innovation and advanced IT services. While Thailand's digital economy is also expanding, its pace is slower, partly due to demographic challenges and lower English proficiency. The Philippines' unique combination of a young, digitally native population and strong English language skills provides a distinct competitive advantage in the global digital landscape. This rapid digital transformation offers compelling investment opportunities in technology, e-commerce, and financial services. Thailand's economy has historically been heavily reliant on tourism, with the sector accounting for over 12% of its GDP before the COVID-19 pandemic. While tourism is experiencing a rebound, this heavy dependence exposes the economy to significant vulnerabilities from global travel disruptions, health crises, and geopolitical events. This concentration of economic activity presents a structural risk. The Philippines, while also a significant tourism destination, possesses a more balanced economic structure. Tourism contributes less than 10% of its GDP, indicating a broader base of economic activity. This diversification provides a crucial buffer against external shocks that disproportionately affect tourism-dependent economies. The Philippines' economic resilience stems from its robust domestic consumption, strong remittances, and a rapidly growing BPO sector. These pillars provide stability and reduce the economy's susceptibility to fluctuations in international travel. For investors, this diversified economic structure offers a more predictable and less volatile environment, mitigating sector-specific risks. Thailand has endured a history of political instability, marked by repeated coups, widespread protests, and frequent policy shifts. Such volatility creates an unpredictable investment climate, deterring long-term capital commitments and hindering economic planning. The lack of consistent governance can erode investor confidence and delay critical reforms. The Philippines, despite its own historical political complexities, has demonstrated remarkable policy continuity in recent economic reforms. This stability provides a more predictable environment for businesses and investors. Key policy initiatives, such as tax reform measures, have been maintained across administrations, signaling a commitment to fiscal prudence and a competitive tax regime. The acceleration of public-private partnership (PPP) projects has been a consistent focus, attracting private capital for critical infrastructure development. Furthermore, the relaxation of foreign ownership restrictions in key sectors has opened up new avenues for international investment, enhancing market access and competitiveness. These consistent policy directions underscore a maturing governance framework. This relative policy stability, coupled with a clear reform agenda, provides a strong foundation for sustained economic growth and investor confidence. For economists, this continuity allows for more accurate forecasting and risk assessment. For investors, it reduces regulatory uncertainty and enhances the attractiveness of long-term capital deployment. The Philippines' remarkable economic ascent is not a mere coincidence. It is the culmination of strategic policy choices, a powerful demographic dividend, significant infrastructure investments, and astute geopolitical alignment. This analytical review underscores a fundamental reordering of economic influence within ASEAN, with the Philippines emerging as a formidable new growth engine. Thailand will undoubtedly remain a significant economy within the ASEAN bloc, but its structural challenges and slower growth trajectory position it differently in the eyes of global capital. The Philippines is increasingly setting the pace for Southeast Asian growth, demonstrating a capacity for sustained expansion and resilience. The critical challenge for the Philippines now lies in sustaining this momentum. Avoiding the middle-income trap will require continued investment in human capital, fostering innovation, and ensuring inclusive growth that benefits all segments of society. Maintaining investor confidence through transparent governance and consistent policy implementation will be paramount. If the Philippines successfully navigates these challenges, it is poised not only to solidify its lead over Thailand, but also to challenge the economic stature of nations like Vietnam and even Malaysia in the coming years. For economists and investors, this shift demands a strategic reevaluation of regional portfolios. Dive deeper into the macroeconomic data, analyze sector-specific opportunities, and assess the long-term implications of these diverging trajectories. Engage with local market experts, conduct thorough due diligence, and position your capital to capitalize on the Philippines' undeniable rise. The time to understand and invest in Asia's new economic giant is now.